to be for the DeFi, Decentralized Finance, and we will have Ledger as well. We will present it, a solution for exchanges and how to store your crypto. I think it was kind of relevant to make the mix with DeFi and Ledger because a lot of people know about this product, and it's the first time they are going to make a presentation here in Bangkok. So first, thank you very much for welcoming Clayton, and let's talk about DAI and DeFi. Thank you.
Thank you, sir. I like having this grass to stand on with my my bare feet here. Are you going to give me a little clicker? Cool. So yeah, my name's Clayton Roche. I'm the ambassador from MakerDAO to Thailand. And yeah, I just want to tell everyone here how DAI works. To me, it is the coolest thing happening in crypto, in the domain of currency, anyway, specific to currency. I'm curious here, who already knows how DAI works? Like, how does it stay stable? Okay, we got 7.5 people. This will test our audio here. Yeah, so to me, DAI, learning about how DAI works was really the switching point for me, being excited about the future of currency in the crypto space. Like, I get the use of blockchain, I get the supply chain, I get the provenance and the way that we can have immutable ledgers, like that's important. But from the currency perspective, I always sort of struggled with Bitcoin, for example. Like, I always experienced it as a speculation tool, not as a currency. I worked in 2017 doing token design, and people would pay me in Ethereum, and like, I had a client in Germany who paid me in the middle of the night, right? And I woke up in the morning to discover I had been paid, and already my invoice was worth $50 less, just because, right? This is not acceptable for payments. So let's talk about what DAI is. So DAI is a stablecoin on the Ethereum network. I'm guessing most people here know that much. It's decentralized like Ethereum, but spendable like dollars. It's the only cryptocurrency that is decentralized and stable with any sufficient liquidity. There's you could sort of raise your hand and mention a couple others, but any that are actually live with sufficient liquidity, this is the one. I went around in Chiang Mai and I asked merchants that were not accepting Bitcoin if they would accept this, and I actually got thumbs up across the board. Most of the complaints or confusion people had about accepting crypto, merchants, I'm talking about sukiyaki and co-working spaces and hotels. I just went across the board, coffee shops, and the main concern around accepting Bitcoin was just the volatility. So I'm going to talk about how DAI achieves this stability plus this decentralization. Stability has previously has been based on governments, right, and central banks. So at the most basic level, behind all of circulating DAI, there's at least $1.50 worth of Ethereum for each one. So it's an asset-backed currency. So what I'm going to explain today is how that's possible, given that ETH is volatile. So how can it be true that behind each DAI there's at least $1.50 worth of each ETH for each one? If the value of ETH is doing this all the time, how can we ensure that that stays true? So that's critical, right? Because an asset-backed currency can't be stable if the asset is plummeting in price, or if it was increasing in price and it was just one-to-one. Then the other piece of this is, how does DAI manage to trade relatively close to $1, reliably close to $1? So that's the actual peg to $1. Very small group here today. Totally happy to get questions. Does anyone have anything right now? I'm very open to the conversational style.
Is it possible to have local stablecoin like Thai, Japanese yen?
Sure, definitely. So the fact that DAI is pegged to $1 is just a choice. It could be pegged to the Thai baht, and there have been conversations around having fiat stablecoins, fiat DAI. There's also, you can create a synthetic version where it's actually backed by DAI, but you have contracts for difference that are creating a synthetic version. So the short answer is yes, it's definitely possible. I think of DAI as very much being in the kind of the early stages, and so this is, to me, like, you know, there's $120 million worth out there in the scope of the financial system. It's nothing, right? It's a little blip. So it's very much in the testing stages in my view. Like live testing, like there's real money behind it, but I think we're probably a ways away from maybe building that through DAI directly. But I also think that there's already synthetic platforms out there that can do that. Yeah, there just has to be a demand for it to create the liquidity. Yeah. Any other questions right now? Cool. Okay, so this little video I've liked a lot. Might require a tap. It's just 1 minute long, but it is good.
DAI is a stable coin, a cryptocurrency that mirrors the value of fiat currencies. There are many high potential blockchain applications that won't work optimally unless they have a stable coin to use. Why? Because people that receive an obligation to be paid typically don't want its value to vary depending on a volatile market. DAI is born when a user takes on a collateralized debt position, or CDP. They deposit many kinds of collateral in an Ethereum smart contract, and a portion of the value of those locked assets are paid out in newly minted DAI, which they can trade for cash in the open market if they like. When the borrower pays back the debt, they also pay a small stability fee, and the collateral is released back to them. The corresponding DAI is destroyed. Of course, if you just want to use DAI as a stablecoin, you can buy it on a variety of exchanges, and you don't need to give thought to CDPs or any other advanced features of DAI.
Okay, so that's just our little 1 minute explainer. So in that video, they talked about a CDP, and that has actually been changed to a vault. Now it's called a Maker Vault. So the way that the vaults work is they're created when someone locks up their collateral. You can see here that the value of the collateral when the vault is created is much higher than the value of the DAI that's output. In order to get this collateral back out, you have to repay the DAI, and then there's also a fee that you would have accrued. It's called the stability fee, and that's the fee that you're paying to take out the loan. So I'm curious to ask people here, where does DAI come from when someone makes a vault? Where is it coming from? I'm sure somebody here knows the answer.
Anybody?
It is minted, very good. So it's not bought on an exchange or anything else. It's actually created at that point when the vault's created. So given that we have that answer, can someone else venture to say where it goes when it's repaid? Yes, it's burned. Very good. Very good. Yep. So that's how that works. So one of the most critical underlying pieces of this, of course, is that if this value falls, in the previous slide we had a $300 worth of collateral, which in most cases is Ethereum, equaling 185 DAI. If the value of that collateral falls, we need to protect the DAI at all costs. The system really depends on the value of DAI being fully backed. And so it will just ruthlessly liquidate positions to protect that. That's definitely critical to the system. So some of that collateral is auctioned off. And it's auctioned off through a system that basically provides some margin for opportunists to come on to buy up that Ethereum and to sell it on an exchange. And it has to do this quite quickly, of course, because if the price of Ethereum is falling quickly, it has to make sure that there's enough time to sell it. That's also the reason that there's a high collateralization ratio. For Ethereum, it's 150%. So the minimum ETH that you can put into the system is $1.50's worth to get one DAI out. You actually shouldn't do that because you'd be right on the edge. If it drops below that, you'll start to get liquidated. So I'm going to use a little analogy here of a pawn shop, just to kind of explain how this vault thing works in another direction. Do we have any questions at this point? Okay. So this is a pawn slip. What this is showing you is somebody brings in a gold necklace and they receive $100 at a pawn shop. They're paying a $22 finance charge, and they're going to have to repay $122 after a month. This works out to a percentage rate of 267% per year. So this is a pretty familiar model where you can bring in something that's valuable, and it's gold, so that it's a liquid market, and it's something that everyone has an agreement about the value of, which is the same of Ethereum. So in the case with DAI and MakerDAO, instead of a pawn shop, it's actually Maker. Instead of a necklace, you're bringing in one Ethereum. And in this case, it was locked in a safe with the gold, but with MakerDAO, it's locked in a smart contract. And then the amount financed in this case would also be 100 DAI, although you can choose to take out less. And in fact, in this case, you'd be taking out the maximum amount, which is a bit risky. Let's assume the stability fee is 10% for this example. If you have your CDP open, your vault open for a full year, you're going to pay a 10 DAI fee. So you're going to have to come back and repay 110 DAI after a year. And once you do that, you'll get your Ethereum back. So how strong is DAI? How well has this system worked, right? As most of you probably remember, Ethereum was up to around $1,400 for a period and went down to under $100. DAI stayed within plus or minus 5 cents of a dollar and successfully held its peg. We're just over 2 years right now of DAI holding its peg and being in circulation. DAI transitioned from single collateral to multi-collateral DAI about a little over 3 months ago. And about 85% of the DAI currently in circulation is this new multi-collateral DAI. It had previously been Ethereum only as the collateral, and now it's also backed by basic attention token. Does anyone have any questions about that, the multi-collateral thing? So right now, the system will allow the governance system to vote in new tokens that can be used as collateral. This can sort of allow for a future where it's not only Ethereum that's backing it. But presently, it has to be an Ethereum token that can back it in order to work in the system, in order to be like reliable smart contracts.
Yeah. One question, and what was the reason behind the choice of BAT as a second pair?
So it was basically a vote based on it was based on a vote. I personally don't know why that one was chosen other than its popularity. The one thing I would say is that any collateral that's chosen has to be sufficiently liquid so that in the event of the price starts to fall and they need to liquidate that collateral, they have to be able to sell it on the market. And actually the same people voting for that collateral are the ones who would have to pay the difference. If there's ever a failure in the liquidation or protecting the value of DAI, it's the Maker token holders whose token will be, what happens is it gets minted and sold on the market to make up for that gap. So yeah, the reason behind it would have to do with that, with both its popularity and being chosen, but also its perception of being a secure choice. So this is, to me, one of the very interesting things about how DAI works. It has to maintain its peg, right, in order to be trusted. So there's two levers. Previously, when it was single collateral DAI, there was just the stability fee. That stability fee is that's the fee that people opening vaults are paying That's the financing fee for borrowing the money. Right now, I think it's about 9%. It's been as high as, I think it went to 22.5% maybe, at a period. It's been as low as 0%. And the basic function of that is that if you increase the cost to borrow, fewer people are going to borrow. And if you decrease it, more people will borrow. The reason you do that is to help control the supply of DAI. So we already explained that when people are borrowing DAI, it's minted, and when they repay it, it's burned. So by incentivizing more people to borrow, you can increase the supply, and when you increase the supply, you're going to move the price point right along the demand line. Similarly, if you're able to increase demand, you could move the price line. This is just a basic Econ 101 chart, right? What's interesting is now we have this DAI savings rate, which allows you to control the incentive to hold DAI, increase the demand for DAI. Right now there are somewhat limited like real world use cases for DAI, just because generally crypto is not accepted as payment by too many merchants. But that's slowly changing. But basically, like once that starts to take over, there's going to be more demand going on that's not just based on this DAI savings rate. The DAI savings rate is cool. It's how I'm earning 8% right now on holding stable dollars. I mean, like savings account options are basically 1%, so I'm earning about 8 times that by holding DAI. And I'm just doing it as a person holding it as money. I'm not borrowing it. I'm just got it on an exchange. I get paid in DAI. So somebody had asked this question on my first presentation on Thursday, which is like if we only pull these levers weekly, which is these stability fee and DAI savings rates, how does it work on an active continuous market? So people here might be familiar with like a central bank, right? They have board meetings once every 3 months or something, and they talk about how the economy is doing, and they choose to adjust the interest rates. Governance meetings are similar. They look at the price of DAI and they talk about changing the fee rates. So I'm curious if anyone here can answer this question. Like if we only change these rates every few days or once a week, how does the price stay stable? How does the price stay stable on the open market? People have come to know that DAI trades around $1. So if you went onto a market and you saw DAI trading for 95 cents, would you maybe buy it?
Sure.
Yeah, if you believed it would be worth $1 shortly, right? So that's one way that happens, right? And it happens a lot more quickly than these levers pulling. Another thing that can happen is somebody can buy it for 95 cents, they're going to buy it, and then they're going to go close their vault. They're actually able to repay their own vault for less money than they got to open it. And so there's actually a net profit for them if they do that. Anyone who's opened a vault would be able to close it for less money than they used to open it. So there's that incentive built to do it as well. So basically there's all these different incentives built in the system that are going to keep it pegged at around $1. And it's up to the governance, the decentralized governance meetings to come in and adjust the levers, the supply and demand levers to keep that trending where it's at. Do we have any questions right now?
So for the exchange, is it the same way they trade DAI compared to the CDP?
So you said foreign exchange,
Yeah.
is it?
If you buy like the DAI directly from exchange, is it trade the same way?
That's a good question. So your question was, if you buy DAI from an exchange, is it created the same way as with the CDP?
Yes.
And the answer is no. In that case, it's actually just being sold on the exchange. And this is actually an important thing I kind of glossed over. So can someone tell me why someone would put their ETH in and take out DAI and borrow DAI? Why would you do that?
The real price is Kulap.
Because because Ethereum price will go up. And what a lot of people end up doing is buying more Ethereum with that DAI. And then they could do another CDP and buy more Ethereum. They can do that a few times, up to about 2x leverage in an entirely permissionless way. So what they're doing is they're going on that exchange and they're buying up the Ethereum with that DAI. So that DAI exists on the exchange just as a stable coin, and it's completely independent of the CDPs in that case. It's already circulating.
So can we take it there is a huge demand for DAI as an indicator that the price of Ethereum is going to go up?
That's an interesting one, and I watched that myself.
Mm-hmm.
Yeah. I don't know if there's like a super reliable relationship between those or not. It's just like any stock. If there's a bunch of longs or shorts against a stock, you can take that as a market sentiment. It's the same kind of idea. Yeah.
Okay.
Yeah.
Because when the price of Ethereum went down, it was as well, the demand for DAI was quite high. So
And
it works both ways.
sure, and so in that case, potentially what's happening, there's two things going on. One is Ethereum might be going down, but people think it's going to go up, so they're borrowing more. But also because there's two different levers going on, there's demand and supply, potentially demand is still high for DAI in that event. Like there's two levers going on, so you're not exactly sure if it's only indicative of sentiment about ETH or not. But yeah, generally, DAI circulation is dependent on bullishness of ETH, right? Which is, in terms of having a scalable supply that can start to be usable as like a worldwide currency, that's another reason that having multiple collaterals is useful. How am I doing on time? Okay, cool. So I'm curious, like, based on what I've told you so far, who feels comfortable that DAI is worth $1? We've got about half, a little more than half, okay. Other people are raising their hand after I said that, like, now you're convinced. Okay, I think I'll accept that number, but let's see, I want to jump forward to this slide right here. Okay, so this is the historical price of DAI. It's only the 96-day period because that's the time that multi-collateral DAI's been out. But what we're seeing here is the price is orbiting around $1, especially for the second half of this graph. The total supply had been quite low over that transition because in order to switch from single to multiple collateral DAI, it was actually a new token, and MakerDAO created a migration process. So it was a gradual process. So what we're seeing here is kind of like the fluctuations you might expect due to the fact that they were migrating. But then you're seeing a lot tighter orbiting right here, around $1. And what I'm also noticing over time is like as the ecosystem grows and as people become more knowledgeable about DAI and use it more, any fluctuation away from $1 is an opportunity that people snap up pretty quickly. Just like in my case, if I saw it trading for 98 cents, I would see that as a fire sale. Like I would come on there and buy whatever I could, just because I'm confident that it will go back up. A lot of times when you see deeper dips anywhere, it's like just on one exchange, somebody might have dumped a certain amount just without paying attention to liquidity. But in general, like that's going to even out pretty quickly. Let's see. So I just wanted to review real quick one enterprise example from a team that we're close with called Concrete. Basically, they're doing invoice factoring, and they're allowing people to buy up invoices at a discount using DAI. This is basic invoice factoring logic. And then the DAI is provided to those merchants, and they can use it to buy new inventory. It's just invoice factoring just allows businesses to sell their invoices instead of waiting for their clients to pay them, so that they can get more working capital. So this is just like one example. It's kind of on the small or medium enterprise level because there's like, if you got into really large enterprises, we're going to be looking at a lot more regulatory concerns, which is an interesting thing with DAI in general. DAI is sufficiently decentralized that there's not the same kind of concerns with like Tether or USDC where those have bank accounts in the United States. DAI is, it's backed by Ethereum, it's backed by the Ethereum network in such a way that's decentralized across the world. A government can't sort of come in and flip the switch in the same way that they could with these other fiat stablecoins. So from a regulatory perspective, things get a little bit complicated. And this, I'll just tell you real quick, this is the company that I'm working for. We're partnered with MakerDAO, and that's also sort of why I have this role as their ambassador. So we're building a wallet that is meant to be mobile money as you know it. One thing you can see here is the balance that you're holding is climbing up continuously, and that's on the basis of having that DAI savings rate in this entire DeFi and lending space. And then what we're building in the wallet has things like no visible crypto and fiat on and off ramps. And it's all layer 2 processing through Connect's network, so you're not paying the Ethereum network fees or waiting the time. And it allows people to use DAI in a way that resembles money as they know it, which is a nice change from Bitcoin.
Okay, so I have a dumb question. Let's say that I don't own any crypto, but I like the 8% saving rates, and I have some US dollar or Thai baht, and I want to buy DAI, and I want to enjoy those 8% without any crypto. Can I do it, and how can I do it?
Sure. So, I mean, the short answer is you need to buy some crypto. And so in Thailand, of course, it's a little complicated at this point, although there is some announcements coming up around that shortly. Yep.
Actually, you can buy straight Thai baht to DAI if you're using Everest.io, which are based here in Thailand.
Okay.
But it sounded like your question wasn't just like, how do I buy crypto?
No, and the thing is that you have US dollar, euro, Thai baht, whatever, and you want to enjoy the 8% saving rates. You don't have any Ethereum or any other crypto, so the only way to do it is to go on an exchange, like Binance or whatever, and buy.
There are other ways that are kind of being built right now, specifically kind of to address that market that you're anticipating. Dharma, for example, allows you to use your debit card in the United States for up to $250 a day without KYC. You can sort of load your account, and they actually support like a 1-to-1 DAI to dollar ratio, regardless of the market price. So there are ways now that they're making it easier and easier to do that, yeah. But it all relies on basically a kind of a bank-style front end that people experience as a familiar bank, and then in the back end is when the DAI, they're handling the DAI part for you. Yep. One other thing, I'm curious here who heard about the DeFi exploit that happened about a week ago. So, yeah, okay, so about half the people here. So, I didn't really talk much about the DeFi lending space. What was the gesture? Was that a 5-minute? I haven't talked about the DeFi lending space too much, but there's a whole secondary market going on where people can borrow crypto assets based on posting collateral. Different places accept different collateral. They have different loan-to-value ratios, which is the amount required to borrow, or like it determines how much you can borrow based on your collateral. So there was an attack. There was actually 2 separate attacks that equaled about $1 million total, and they both happened on the BZX platform. The lending platform is called Fulcrum, and they were based on using these things called flash loans. And flash loans are something that exist on Ethereum that allow you to borrow assets with no collateral, and the loan only occurs if you repay it before the next block is mined. It's goofy, right? You're literally borrowing money, but you never borrowed it if you don't repay it. And that's why you don't need collateral for it. Well, what happened was some people figured out, just some brilliant guys or girls, figured out that you can take a flash loan, and I'm not going to maybe explain all the steps of this because I think it's going to get too esoteric, but essentially what they were able to do is they took out a flash loan, they sold half of the assets they borrowed on one of the exchanges that was being used as an oracle, a price oracle. So basically one of the exchanges is saying, hey, SUSD is worth $1. Well, someone came on there and they bought it all up. So then suddenly Uniswap was saying that it's actually worth $2 because of the way that Uniswap works. And they were able to then borrow more money than they should have been able to from Fulcrum on the basis of tricking the system into believing that this asset was worth a lot more than it really was. All of this kind of comes down to having used an on-chain oracle. Do people here know what an oracle is, a price oracle? Okay, a price oracle is it's the thing that tells these systems what an asset's worth. And when I first heard about this problem, I was like, what do you mean? Just go on an exchange and see what it's worth, right? This isn't a complicated problem. Turns out it's really complicated. And it's really hard to trust the source of that information. And part of the reason is because it's so profitable if you can successfully lie about the value of an asset. And what these guys did is they figured out how to trick one of the platforms into getting the wrong information. Most other platforms are not using, including MakerDAO, are not using decentralized oracles. They're using sort of semi-centralized systems. MakerDAO's case, we have a bunch of different oracles, and we take the median price. So if one or two of them even conspired to throw off the price, they would still find it very difficult to adjust the median price. But because BZX used a decentralized oracle, and it was actually one that was easy enough to manipulate, somebody was able to basically do market manipulation without being a whale, which is sort of like a new level of democratization of scamming. Yeah. So that's kind of what I have for you guys today. I don't know how we are on time, if there's time for questions.
Any question on DAI?
Yeah.
If I own some DAI and I would want to profit from the interest rate, do I need to put that in a specific smart contract or in a specific wallet, or can I just put it on MetaMask and pay interest?
You do need to do something with it. There's a number of different options. Just to tell you my favorite one, you go to chai.money and you open your MetaMask, you hit convert, and then you're earning. It's very simple, and it was built by the same, it's just an extension of the same contracts that MakerDAO used, and it's built by the same guys.
So that amount of DAI will be locked away into the Chai contract?
Yeah, actually the way that works too is they actually give you send in your chai and they give you, you send in your DAI and they give you chai tokens. So you have chai sitting in your wallet. And yes, exactly right. The DAI is in their contract, right? And when you're earning the DSR, the DAI savings rate, there's no counterparty or third-party platform risk because it's just being locked up as this the way that the DSR works with their little lever that they're playing with, as opposed to something like Fulcrum or Compound where it's actually part of their lending system. So when the rates are pretty close to each other, I personally would just use the DSR if there's not much benefit to using one of the other ones. Yeah.
One more questions before the new presentation. We're gonna have some time for some questions after all, but one more. Good. That.
Okay, I want to ask about everything that when I open a CDP, every DAI I got in the CDP. What if my CDP got there? So it means I still know that, but all CDPs are not so out. So it means after that time, all the DAI I hold, I don't need to pay everything anymore.
So, like, yes, it's like you're winning, but in the worst possible way.
Yeah. So it means if it's like a lot CDP, let's say 10 million,
Okay.
start with today.
Yeah.
Okay, so it means later that like 10 years later, all 10 million that we pay anymore.
Right. So when that happens, actually the liquidation is paying your fee for you when that happens. So your fee is being paid out of the Ethereum. You've already paid it because the collateral you put in was worth so much more than your DAI anyway. But you're right, like that DAI, someone else has already sort of paid it because they closed your position. Yeah, once that DAI that's outstanding that you sort of have now, it's actually owed to a different CDP now because your DAI was already repaid and burned by these liquidators. Yeah, however you want to look at it. Like every DAI was born in a CDP, or in a vault as they're now called. And because yours got closed, it doesn't matter sort of who has the DAI. In order to close a vault, DAI needs to be put back in. It's perfectly fungible though. Yeah, to get back to your original question though, yeah, you never have to kind of go and repay that stability fee. It was paid out of the value of your collateral, which was sold at 150% of its value.
So it means when the auction, another one will buy CDP and hold that.
No, they'll buy the collateral. The CDP will actually be closed, so they'll buy the collateral with DAI, and then they're going to burn that DAI. So it's actually closing your vault. They're just getting the collateral, not the CDP.
Yeah, another question to go back on the multi collateral. Any example that you showed of the phone shop? I think it's really cool. Example of given a case, you get cash, and if you take this idea on the blockchain world, like what's needed so that you can bring real assets as part of the collateral on Maker, and are the companies working on this?
Yeah.
What's the space looking like?
Sure. So that's a huge question, and like it's one that's close to my heart. So just to rephrase the question, like right now you can borrow against Ethereum. When can we borrow against a gold necklace or a house or a car or a motorbike, anything like that, right? The reason that's near and dear to my heart is like my mom doesn't benefit from MakerDAO's vaults. She doesn't have any Ethereum, certainly doesn't have an opinion about the direction its price is going to go. So once we can have real world assets in there. So how can we do that? When is that going to happen? That kind of comes back to that Oracle problem, and it's a much bigger Oracle problem. It's how can we get real world dirty meat space data onto the blockchain in a reliable way? There are places working on that, and actually the enterprise example I gave of the invoice factory, that's an example of a real world asset going on chain. There is a chance that any one of those invoices will default, and so in that case, if they never repay the asset, like it's not as secure as Ethereum, right? As a secured loan goes, and that's going to be priced into the interest rates, which is why there's potentially more reward and more risk. People are talking about it, like MakerDAO's talking about it. It's on the table. Some people are very much kind of purist, and they think it should only be crypto assets, especially when it comes to backing something so important as the stablecoin. What's cool is there are other platforms like this that can take that on instead of MakerDAO. Like MakerDAO can stay pure and could stay crypto assets, and some people even want a pure DAI that's based on just Ethereum, while third parties can build out this kind of approach. The problem with a mortgage, for example, like house ownership being in a vault, is like we need the governments right now are the entities that enforce ownership. They're the ones who say, we agree that this is your mortgage and that you own this house. So the government, government will like send police to kick someone out of your house if they're not you, right? In order for that to happen, we need on-chain, for ownership to work on-chain, the government has to recognize on-chain ownership, and that's complicated, right? That's a whole different thing. It comes down to regulation. So it's kind of a ways away, I think, to where we're doing that, but there are certain spaces where it's happening, yeah. It's a good question, thanks.
Okay, thank you very much, Clayton, for your presentation.
So thank you all so much.
So you have to give me 2 minutes because this is the moment of the meetup where I need to call, and it's always a problem. So sorry for that again. For the one who were not here, actually Glenn from Ledger didn't come because of the coronavirus. was quarantined in Hong Kong. So we have Samuel, his colleague from Singapore, which is going to give the presentation through a call. So just give me 2 minutes, please. Thank you. Can you share your screen for the presentation?
Okay, so let's see.
So everybody, this is Samuel Peng from Ledger, based in Singapore. So thank you very much for Samuel to join us tonight and to make the replacement from Glenn.
Okay.
All right.
Wonderful. Can you see my screen now?
Yeah, perfect. We can see the screen. Thank you very much, Samuel.
Wonderful. So am I good to go?
Yeah, everything is okay. You can start. Thank you.
Okay, right. Well, good evening, everyone. Apologies, I can't see any one of you there, but I hope all of you can see my screen and understand it's a exciting night, and I'm sure Clayton must have had a very good presentation just now. So anyway, as you can see from me and the picture on the lower left-hand corner, look very different from the person called Glenn, and obviously I'm not Glenn. I'm Samuel here. I'm Samuel based out of Singapore. I'm part of the Ledger APAC team. And unfortunately, Glenn, who's supposed to be presenting, he's being caught up on some of his travel arrangements due to the current situation. So here I am standing in on the last minute. So hopefully I'll be able to do a good job to engage all of you. So again, thank you, Max, for having us. Ledger to be here presenting. So I'm Samuel. I'm based in Singapore with Ledger APAC team, as I said earlier. So just a quick story about Ledger. I'm sure most of you must have heard of or are familiar with Ledger Nano, which is the world's leading hardware wallet, as far as I know. So Ledger started out sometime in 2014. And Ledger was created with a group of about 8 co-founders, all with different backgrounds from the banking sector, security sector. Because of their combined background, they find that it's complementary. And with the interest in the blockchain technology, they realized that they can actually use, our co-founders can actually use all the different experiences to incorporate security into the blockchain and the cryptocurrency world. And so Ledger was born from 2014, and Ledger Nano was the first product. And since then, we have also moved on into different product lines. And very much similar to Ataco, as I understand, we also have 3 business lines. Of course, the first one is the retail crypto wallet, the Ledger Nano S and Ledger Nano X. The second one is our institutional solution for custody, which is called Ledger Vault, and I'll talk about Ledger Vault more later. And last one being our IoT solution called Ledger Origin. So just a little quick, perhaps I'll just talk a little bit quickly about custody. Now, we've seen custody going from cold to fluid, and when people first started trading cryptocurrencies, they usually put them on the warm wallets or hot wallets, and then as it goes along, we start to put them into hardware wallets such as Ledger Nano or Trezor, or even paper wallets. But that essentially is not an ideal situation for high net worth individuals or even for institutions trading cryptocurrencies. And so a lot of them have since then also gone to cold wallet storage, which is the default storage used mostly by crypto exchanges or by crypto providers today to mitigate against cyber highs, against hacking incidents, which we have all seen a lot in the last 3 years. So, and Ledger has also gone ahead. Instead of just focusing on the B2C market, we've gone ahead thinking about the institutions, the financial institutions on the way ahead. So, which is why we have Ledger Vault in mind. Now, going on to the next slide. As we talk about digital assets today, You know, in the last century, when oil was found, it was called the black gold. But in this current century, with the digital asset, it is called a new oil, or perhaps you can call it a new digital gold. And with all these digital currencies and value and assets, increasing digital assets flowing around, the next most important step will be how to secure your digital wealth, your digital assets, because you certainly will not want to be a crypto millionaire one day, and the next day just to find that you meet someone else a millionaire. So as I said earlier on, these are the three product lines we have with Ledger. On the left-hand side, you can see our B2C line, which is the Ledger Nano, our hardware wallet, which is primarily catered to the retail market. And the one in the center is called Ledger Vault. It is what we've started developing just about 24 months ago, because interestingly, a lot of our current present-day institutional Ledger Vault clients actually came from using Ledger Nano. So we saw that a lot of our clients, the financial institutions, they were using Ledger Nano to secure the crypto assets. And we thought to ourselves that this is not ideal for institutions because it definitely works differently. For example, how I will store my money by myself and how a bank will store their money is totally different. So that's how we came about with Ledger Vault. And of course, the last one is our Ledger Origin, which is our Internet of Things solution, which can essentially cater to help secure the data on anything that's traded or that's available on IoT, such as a tradable energy, for example, and many other use cases. So going on to the next slide, I'd like to talk about financial assets for the financial digital assets for financial services. Now, among the most important things for financial services when you talk about digital assets is transparency, cybersecurity, and stability risk. And I'm sure many of you in the audience who are all very experienced in the cryptocurrency world, and I'm sure many of you sitting there also come from the traditional financial world, just like I did. These three are the most important things. The reason why the financial institutions, the banks, have not jumped onto the bandwagon of cryptocurrencies is primarily because of how they are going to control that, because of AML, CFT measures, and because of cybersecurity issues, and of course, because of regulatory issues as well, and how stable can these cryptocurrencies, digital assets be. And it does not help. Of course, it doesn't help at all with all the news in the last 3-4 years to see how many crypto exchanges have been hacked. And just even as of last year, $4 billion have been hacked. In fact, if I got the figures correct, this figure is even much higher than in 2018. Although collectively, although the amount of theft for each cyber hacking is lesser, case by case basis. But overall, last year itself, the total crypto theft is up to 4 billion. So this is a major concern for a lot of financial institutions. So as we talk about digital assets, as I mentioned earlier on, the next important thing before financial institutions can come into play is to talk about custody solutions, how they can safely store, safeguard their digital assets. And of course, some of the features and pitfalls of cold storage as well. Now, in today's world, as we know, even a lot of crypto exchanges or even some of us who hold large amounts of crypto assets, we tend to focus on cold storage, such as perhaps holding and again, perhaps just let me go one step back. Today, when we talk about digital assets, we are essentially talking about securing our private keys, because our private keys means everything is the only access to our digital assets. Once we lose our private keys, essentially we lose all our cryptocurrencies, our digital assets. So today, a lot of crypto exchanges or even a lot of retail traders, those who hold a large amount of digital assets, we tend to focus on cold storage, such as paper wallets or hardware wallets. But by so doing, we also can essentially forget to protect and how to isolate our private keys. What do I mean by that? Now, when we keep our assets in cold storage, whether it is offline, in a vault, or in a physical vault, in a bank vault, for example, or just in a hardware wallet, or just in a paper wallet, that can essentially limit our access to funds. So if you are a frequent trader and you want to participate in the market fluctuations, especially we know in the cryptocurrency world, the price can move today and next day in a couple of hours, for a few $1,000s, say Bitcoin, for example, you can essentially make such a big move, a few $1,000s. And it changes so ever frequently, so fluid. So if we are going to store everything in cold storage, we'll be losing out on all these market fluctuation, which can essentially help us to profit from the market. And this is especially important to institutions as well. So if hedge funds, family offices, they're going to get involved in cryptocurrencies, they will want to be able to have liquidity, to have quick access to the crypto assets, as opposed to having to spend 24 hours or days just to get access into the digital currencies which is stored on a cold wallet, cold storage. So bringing a fluid experience is very important. In fact, possibly is the most important thing in the name of digital asset custody. This is very important, especially when it comes to the mainstream institutional players. As we have seen from the traditional financial market, when a market opens up, the hedge funds comes in, the family office comes in as well. So when this problem is being solved, the problem of liquidity, access to funds on digital assets is being solved on the cryptocurrencies, then it would certainly encourage a whole lot, a tidal wave, if not a tsunami of the financial institutions, the hedge funds, the family offices to get involved in cryptocurrencies, which will be very exciting and very healthy for the crypto market. Now, a few of the things that we definitely want to look at when we consider a digital asset custody solutions. Of course, the most important thing will be security. How is the physical access to the private keys being monitored and protected? You certainly do not want just a single point of failure whereby just the CEO has access and is holding to the private key. And we have seen what happens when when this is the case. Take, for example, the case of the Canadian crypto exchange Quadriga CX, whereby the CEO was the sole and single only owner of the private key. And then he went MIA for some reason, either by choice or by accident. Everything is lost. So we want to ensure that that is being prevented. Of course, how is cyber risk being monitored and mitigated? How do you ensure that your screen is not being compromised so that what you see is really what you're signing? And of course, whether sensitive information and transaction communication are being securely transmitted, or do you always have to watch over your shoulder to see whether somebody is monitoring your transaction, is silently monitoring your flow, your behavior online? For those in the audience who are cybersecurity experts, I'm sure this is an area that is very familiar to you. Of course, the next thing is governance. When I talk about governance, we are talking about internal governance and perhaps external governance as well. But more so, for any custodian, for any institutions that wants to custody their digital assets, what sort of governance rules do they have? So for example, banks, you have governance rules, you have AML rules, you give different access to the front office counters, officers in a bank branch. They will only have access maybe to view the bank accounts of certain people, and they are not able to view the accounts of private banking clients, for example. And others, they are able to authorize transaction up to maybe, say, $1 million. So in the same way, how is the governance structure in the cryptocurrency when it comes to the financial institutions? This is something that's very important. And of course, the next important thing is regulation, and which is something that I'm very happy to say, and I'm sure all of you can agree that even in Thailand, Singapore, and in different countries here in Asia, especially in ASEAN, I think we are way ahead when it comes to regulatory developments as opposed to even the United States. For example, in Singapore, the Monetary Authority of Singapore just last month on the 27th of January implemented the Payment Services Act, a licensing requirement for all crypto services provider. So with all this regulation, it provides a clear audit trail, reporting structure, and also helps the crypto services providers to become more legitimate. Of course, does your custody technology provider, are they being certified? Are they being monitored by trusted third parties? So I'm very happy to say that here at Ledger, with Ledger Vault, which is a institutional custody solution, we have been very, very severely audited and tested, pen tested, white hat hacking tested by Arch, one of the largest, if not the largest insurer in the world. And because of that, we spent 6 months with Arch Insurance. They tested, pen tested our technology, and they have full faith and confidence in Ledger Vault's technology that it cannot be easily compromised, it cannot be hacked, which is why they have agreed after the last 6 months, since December last year, to actually insure Ledger Vault on a insurance policy of up to US 150 million at this point of time. And this goes to show how much confidence Arch Insurance has on Ledger Vault technology. And very happy to say that this is perhaps, I think this is the one and only insurance in the world at this point of time that is specifically insured on the technology itself, in this case on Ledger Vault's technology. And the premium for this technology is not high, which means that the insurer has high confidence in our technology, that it is very secure. It is a bank grade, and I'm very happy to say that Ledger Vault is in fact a bank grade security. And Arch Insurance is confident enough to issue the insurance at a relatively low premium for us Ledger. And of course, in terms of regulation, let's talk about independent disaster recovery. Is there a BCP, business continuity plan, when something happens to the custodians or the crypto exchanges? And lastly, we talk about efficiency. Does the custody solution allow the company to operate efficiently? Or do all the holders of the private keys, say the CEO, the CTO, and the CFO, do all of them need to come together physically in one location in order to release the funds in cold storage? So all these are very important consideration for institutions when they talk about custody solution. Yes.
Yeah. Can you hear me? Maybe I will make just 1 minute. Any questions on this? Because it's kind of really new that the institutions are using cold storage solution like Ledger. Any question in the audience? No, but no, we can continue and we'll take some questions just after your presentation.
Yeah, sure. So I do apologize again if I'm going too fast or I'm not sounding too clear, as I can't see any of your reaction there. So please do let me know if you have questions or anything. Thank you for that. So yep. So the next step, of course, we are talking about preparing for the tokenization of assets with banks in mind. And that is what Ledger Vault is all about. Now with Ledger Nano, the hardware wallet, it is in fact, we sold more than 1.5 million Ledger Nano hardware wallets throughout the whole world to more than 170 countries. And I think that is in fact a formidable feat for a young company. But having done that, we decided that the next thing is not on the retail market, but rather to look at the institutions, which is why Ledger Vault comes into play. Now, this is a quote taken from a survey done by Deloitte and Touche. It says that the act of tokenizing assets threatens to disrupt the traditional financial industry. Those who are not prepared risk being left behind. And which is why today we see a lot of banks, including in Thailand and Singapore. Say in Thailand, I think the BOT, and even Malaysia recently, and of course in Singapore just beginning of this year, the central banks have started to issue digital banking license. Why is that so? Because the central banks realize that they cannot avoid the onslaught of digitization in the financial sector, and the banks notice that too. So they will have to come together banks, financial institutions, the government, central bodies, of course, the private expertise like ATACO, and of course, with Ledger and many of you sitting in audience there. We have to come together to work with the regulators to find the best solution for the entire industry to move forward. And in this aspect, Ledger, how we have done so is that we have been actively involved in discussions in committees with the central banks, even here in Singapore with MAS, and also actively getting into involvement with the regional ASEAN central banks. And of course, recently our CEO of Ledger was also involved in at Davos at the World Economic Forum, WEF, just so that we can provide our expertise, our views on security, on crypto securities to the government. And when it comes to financial institutions, in terms of token economy, four main important things they will mostly look at. Number one will be the business model. We'll definitely want to be leveraging our experience, or rather the banks will want to leverage their experience as a custodian bank to safekeep the assets. And at the same time, to make use of expertise from us, from the private sector, those who are experts in cryptocurrencies, on how to maintain customer accounts in cryptocurrencies, and to facilitate the liquidity transaction, the trading, the swaps of the cryptocurrencies, crypto assets as well. The next thing is platform. When I talk about platform, I'm talking about infrastructure. The retail market is very different from big institutions. So big institutions, say for banks, for private banks, we talk about infrastructure, how to support large amounts of clients with large amounts of assets, with not just millions of dollars, but we're talking about billions, hundreds of millions and billions of dollars worth of assets, and we're talking about digital assets. So the infrastructure-wise is going to be different. And how is this infrastructure going to be compliant with the regulations, with security, which is the next point, on AML, KYC, which has been largely touched upon. And the US, they have been focusing a lot on AML, KYC, even in Korea. Lately, they have been paying a lot of attention, but unfortunately, they are paying attention on the taxation side. And even in Japan, the regulations, I believe, come this April 2020. All those who hold digital assets in the hot wallets must have the equivalent amount of the digital assets in cold storage as well. And that is going to be a very hard call for a lot of crypto services providers in Japan. And of course, here in Singapore, with the Payment Services Act, it also has provided a very clear guideline for crypto services providers as well. And last thing, why is it highlighted in orange? Well, we're talking about security, and of course, that is where Ledger comes in. It is our core business. It is our core expertise. So we're talking about not just securing our wallets, but also our private keys, how to use governance rules, operational rules, to customize to your own operation, to have trusted HSM and secure elements to make sure the entire communication from end to end is secure. And this is where Ledger Vault comes in, the institutional custody solution that we have.
Okay, thank you very much for the presentation. Just maybe quick questions. Anybody? Yep. Actually, yeah. One.
I was just curious what the state. I was just curious what the state of regulation and security compliance in Thailand. What is the bank of Thailand doing?
I'm sorry, Max, can you repeat the question? I'm very trying to hear that.
It was a question on the regulatory for that.
Okay.
Regulatory side of Thailand compared to Singapore.
Okay. Well, pardon me. I think on the Thailand regulatory side, I have to read more into it. But I believe Thailand is in fact one of the forerunners when it comes to clearer regulations on cryptocurrencies.
Yes. I can just add a bit on this. There is a royal decree which has been passed last year, which gives a regulatory framework for all digital assets here in Thailand. So Thailand actually is one of the more advanced country in terms of regulation of cryptocurrencies and digital assets. So that's why you have companies doing any ICO portals, exchanges here in Thailand. It's because it's fully legal. And I believe that Khun Nattapon and Kulap knows about it very well as well. Thailand is very advanced, even compared to Southeast Asia region.
So I totally agree with that, which is why Thailand is a very interesting, exciting market even for myself and for us here in Ledger. So in terms of regulations, why on crypto assets, I think Thailand is overall very welcoming. And the fact that Thailand is also I think is the first to issue out license for crypto exchanges, for crypto services providers, that I think is very encouraging as well. It also sets a very clear guideline for the services providers out there, while at the same time protecting the consumers. So when
And
so when it comes
one of the following questions, maybe can you share a bit more about the customers of Ledger Vault? I believe it could be hedge funds or any company like this. Can you share a bit more on this?
Yes, so currently Ledger Vault, we have more than 40 institutional clients throughout the world, including some of the big names. So for example, in Japan, we have a joint venture with Nomura Bank to form their digital asset custody called Komanu. So as you may know, Nomura is one of the largest, if not the largest, traditional asset custody bank in the world. And the fact that they partner and JV, joint venture Ledger to provide digital custody, I think speaks volume. And in Thailand, we also have a couple of clients. Because of NDA, I cannot mention the names. But in a nutshell, the reason why they choose Ledger, of course, is not just because of our expertise in security that comes from the banking world. Ledger Vault, again, is the bank-grade enterprise security solution for crypto assets. It also answers a lot of some of the regulatory concerns. For example, customer protection, data loss protection, treasury risk management, and business continuity plan. All these are in some ways protected and answered with Ledger Vault solution. I hope that answers your question.
Thank you. One more questions for Samuel, which is here from Ledger. No. Samuel, you want to conclude something on your presentation?
Sure. Right. So thanks for the question anyway. So with crypto assets, we're talking about different level of threats as opposed to the financial, traditional financial world. Some of them are same, but some of them are different. Now, as I mentioned, I came from the traditional banking world. In my previous life, I was serving the ASEAN regional banks and central banks, including BOT, Stock Exchange of Thailand, some of the big 5 banks in Thailand, including K-Bank, Khun Sri Bank. So if you remember, 3 years or 4 years ago, there was a very major incident whereby hackers, they took away $80 million from the Bangladesh central bank by the SWIFT network. So I was serving a lot of all these banks on the SWIFT network. And because of that, we started to look at how blockchain can help to more secure or rather more safely secure the bank's assets. So in the crypto world today, we're talking about different risks such as fiscal risk, malicious insiders, third parties, and everything, all these risks that you can see listed on the slides. So when it comes to Ledger Vault, how we mitigate all these different risks, well, because Ledger Vault is for institutions, it is not a hardware wallet which is being held by the CEO, one person, or paper wallet. So it is impossible for anybody to go after the CEO and steal the paper wallet or the hardware wallet and force them to reveal their private keys, because it is not hardware. And at the same time, the keys itself, the private keys, are being secured in various forms and then separated into different portions. So you need to combine all the different portions before you can get the main private key to access to the assets.
Okay.
Yep. Sorry. Okay. Red Vault also protects against insider from insider fraud, whether it's whether it's the customers, the clients, insider fraud. Now, just to be clear, Ledger is not a custodian. We do not hold your digital assets with us. So we are not the same as, say, BitGo or Coinbase custody. But Ledger Vault is a technology provider. Ledger Vault is a technology provider, and Ledger Vault is the custody technology that we provide for you, the institutions, to do self-custody.
Okay, thank you very much.
Thank you
Thank you very much for your
presentation, Samuel.
Yep.
Thank you for taking the time. I know it was not easy to make the call, and thanks for taking the time for explaining us about Ledger tonight. Thank you.
No problem. So, if you'll just allow me just to share one more slide quickly before we go offline. Is that okay?
Sure, go ahead.
Yep. Just hold on, please. All right, so for all of you who like to know more about Ledger Vault, you can kindly go to the link in orange at ledger.com/vote and download the white paper. Any questions you have, please feel free to reach out to us. Thank you again for your time tonight. Have a pleasant evening, all of you. Thank you.
Thank you very much. Thank you again. Thank you. Okay. The mic doesn't work. So, Kuntat, if you can make the last presentation of the evening. Just to come back one thing on Ledger. Actually, there was a very famous sentence from Mike Novogratz, who was saying the institutional are coming when there was the bear market. And the biggest issue for institutional players were that they could not hold crypto by themselves because of insurance. So if companies like Ledgers or others are trying to bring solutions to that, we might see some of those institutional filing coming in the crypto space. So anyway, thank you very much. Kuntat for Kulap.
Okay, while waiting for my slide,
It's coming.
I'd like to ask that how many of you guys have ever used decentralized exchange before? Decentralized exchange? Okay, less than a half. Okay. Okay, for this session, I will talking about the decentralized exchange landscape and how it works for comply with the law. So we are waiting for the license, and until now we almost there. We almost got the license. I expect that we got in around half of this year. So it's this exchange with the license. Actually, it will be the first this exchange in the world that under regulate. It means the customer that go to all service need to do the KYC, comply with the ML, and pass through all the things. And every round that we allow user to match the market need to all pass the ML policy, for example. So for me, I am Todd. I'm a CTO of the Kulap that we do the decentralized exchange that I mentioned. The tech area that interests is Ethereum smart contract because we do decentralized exchange that run purely on the blockchain, or the order matching it run on the blockchain, and WebTJS of course. And I learned about Bitcoin, and I do some the Libra wallet that is the first Libra wallet that allow the more than 100,000 that use worldwide after it launched on the testnet as well. So what is the decentralized exchange? So it's exchange on the wiki that it said that it's a cryptocurrency exchange which operate in the decentralized way. So it means it add the name that we have a centralized chain and decentralized chain. So decentralized chain need to be operated from in a decentralized way. Without the centralized authority, decentralized chain allow peer-to-peer trading of any cryptocurrency. So it means only cryptocurrency. You cannot trade fiat with the crypto in decentralized chain. It needs to be token first. That's why we list the DAI as a base token pair on off-chain as well. So we have, before we go dive to this chain, I will compare with the simplified first. For chain that you might know, the very famous one like the Binance, Coinbase, on Bitget is the centralized chain. For chain we have the Kyber, Bancoin, Uniswap, Etherdata, and anything that run on the blockchain. So for the left-hand side, the exchange controls the funds on behalf of the user. So it means the user needs to deposit the funds to the exchange first before start trading. And after finish, user can withdraw it back to their wallet, for example. For the decentralized chain, user fund can no need to deposit in the decentralized chain. It means user fund can hold on the crypto wallet. And user just open the website to exchange one by one. And after that, user can go off from the website and switch to the different one. It means that there is no lock on the fund on the different exchange. But it depends on the protocol because some protocol have user that need to deposit first before trading. So it means user need to withdraw before moving to another different exchange. It depends on this exchange. And because of this exchange, some of this exchange run purely on smart contract. It means no server downtime. It means user can trade 24 hours without worry about the server downtime like Uniswap. Uniswap is run on the smart contract and they open source on the front end as well. So anyone can pull the GitHub and operate the front end for the swap without no need to enter the uniswap.com for example to make it swap. But for in terms to liquidity, you might see that liquidity on the exchange is much more larger than the decentralized exchange. It's very small, less than the 1% of the volume of the total on the exchange now. So I will talk more on the low liquidity, that how to solve this problem. Okay. Before we dive into how to solve the problem, I will give the detail about all the DEX landscape first. I separate the DEX landscape into two categories. One is the order book. Order book is quite similar to centralized exchange. User bid ask to the order book, just a maker and taker and matching on the order book. On the right is a reserve pool. So how many of you guys know how the reserve pool works? Okay, good. So that's why I prepare that today I will dive a lot to the reserve pool because order book is easy. I assume that everyone knows how the order book works. On the reserve pool, it means that in the one single pool need to manage two tokens. For example, Ethereum and DAI. So it means the pool hold two tokens on the smart contract, and when user trade, it will know the price, and it will give the price to user, and user just start instant trading with the smart contract. No need to make the order bid or ask to the blockchain. So it means we can say that this pool is an instant exchange. So for the output, user need to be the maker and taker or post the price on the blockchain and taker matching on the blockchain. But for the pool, we call the liquidity provider. So it means everyone in this room can make a profit by becoming the liquidity provider. Like for the Kyber, Uniswap, and Bancoin, they open to everyone that can provide liquidity to the pool. And every time that pool have trading fee, they will give back to you as a portion. So it means you can earn profit by providing to the pool. And right now we have many DEX that have this reserve pool. So it means you have many choice in the room for now. That you can compare with the loan. For the DSR, they have for the DAI we have a DSR, right? So it means if one pool have a lot of volume, and the volume itself, the trading fee maybe can earn more than the DSR. So it means if the pool have less volume, it will pay out less than the DSR. So after the DSR come out, I think the pool is it's make really competitive to the market, because if it's not pay out that more than DSR, so people to put to DSR instead, for example. So for the order book, if you trade in a large amount, you might see in this page that it shows how the liquidity pool works out, that if you buy or sell, it's how much that you can buy without much price sensitivity. For example, that is the order book. But for the pool, we can call it's the bounding curve, that you every time you trade, the curve will slightly shift right or left. Is that how the price calculate? This is how the bank call or Uniswap works. So it means that you can see this is the O position. This is the O position on this now. And if you start trading, like for example, if you buy more token, the price will shift to this one. The X is like the token of the Ether, for example, and the Y might be the token for the DAI, for example. So this is how the bounding curve works. So it means that we don't need the price oracle here for this model, because the price can auto recovery by the smart contract by itself. Like this swap, you need to provide, we don't need the price oracle outside the world to put in smart contract. The smart contract will adjust the price by itself by the demand of the market. If the market buy more, the price will increase. If the market sell, the price will decrease, for example. But for some different exchange like the Kyber, they have some manager that can force the price to the smart contract, and they have the smart contract itself that calculate the price also. So for the Kyber, it's like the semi between the bounding curve and the manager. So it depends on the design exchange that manage the reserve pool. And how it works for the order book, the book is quite easy. User just post the order book to the smart contract, and it records on the smart contract, and they have some relay that open for the API point for easier the author taker to look up on the order book in the ecosystem. But for the reserve pool, it's quite different. User no need to bid or ask to send. User just send token A, and the smart contract will give back the token B. For example, token A is Ether, token B might be DAI. If you put the Ether to smart contract, it will give back your DAI, just as you see. But behind the scene, we have the reserve pool that for the author contributor can provide to the pool. And we might have the reserve manager for this Kyber network that manager can adjust the pool and can connect to the Kyber network protocol. So for the DEX right now, that for the order book, we have like the 0x is the popular one and the bigger one for now. And we have the AirSwap, IDEX, and Etherta that do for the order books. And we have some that do the reserve pools. Right now, the Kyber, Uniswap, and Bancor. The biggest one is the Uniswap for now. More than the half of the DEX volume right now almost happen on the Uniswap. So right now, we can say that Uniswap is like the more gain popular than the other books now, but 0x just launched the new version just last year, so we can see that it's like a competitor together between the two way of the order book and reserve pool. So to summarize the on-chain order book for the about how it works and for the property of the on-chain order book. Order book we do the on-chain ledger, so every bit and ask is go on-chain. So remember that every big and ask action need to be go on chain. And anyone can access the order book, and anyone can submit the order to order book. But because of everything is come to on chain, so the trade-off is very slow, and it's really cost. It means that the maker and taker need to pay gas every time they trade. And actually, every time they cancel, they need to pay for the gas cost as well, because everything is happen on the smart contract on chain. So and for the update, it takes time. For let's say the Ethereum block time is around 15 seconds, so it means you cannot update the cancel immediately, for example. But for the basic itself, it's not sensitive. Everyone, because everyone can access to the ledger, so everyone can post and trade. And public access and no centralized party control the order book, because everything is on the smart contract. For the off-chain order book, they have some order book that built on the off-chain as well. Off-chain order book is mean a ledger is built on the off-chain, and order book can be accessed by the API. So it's not on smart contract by the API. But every matching needs to be happen on chain. So it's like it's the balance between the yes. Okay. Yeah. Yeah, the IDEX is the option of the book because they have the paper, the white paper. They said that on the order book is on the database, and the user needs to like a sign message that I need to pull like the make and take, and every machine after that they will batch by the operator to the on-chain. So these are how the off-chain order book works. Yeah. Okay. So access the order book is by the API. But when it comes to settlement, it will go on chain. But on chain by the operator, yeah? Okay, no. Okay, by the on chain by the operator. So the benefit of the off chain book is the performance improvement a lot because all the maker, taker, and cancel no need to pay for the gas. It's just a matching. It's like just match and go on chain. So it's much more faster, but and cost improvement. But when it comes to trade off, it's a centralized party required. That as I said that every order book needs to access by the API. So it means a server can go offline, and your fund can go stuck to smart contract because all the order book API like the IDEX one, they need you to like open the wallet first. So it means deposit and lock to that smart contract. So it means if manager or operator go offline, you need to wait like 1 month before you can you can withdraw from that. And it can censorship, yeah, because it operates by the one centralized party, for example. But yeah, it can build further build on the decentralized way like the Plasma or the DPoS or POS work on the off-chain, but until now they're quite centralized now. And the last one is a no order book that is quite popular now. It's instant exchange. It no need to post the price on the smart contract. Smart contract just give the real time price, and you just okay, you want this price or not. If you don't real price, you can maybe wait for tomorrow to take. You cannot like okay, I want to buy this price and post on the order book. Cannot because we don't have the order book. We have only the real time price here. And the price calculation is calculated on chain on the smart contract is more easier with the different Author DeFi protocol can connect with. Right now, if you for example BZX for example and Compound, no Compound and other protocol that build like the lending protocol that need to exchange behind the like a synthetic for example, they need to have the debt. And for the deck they use the instant exchange because the order book is more complicated. It's quite complicated to find the order book to match the price. For example, if the lending protocol want to sell the 100 or 1,000 DAI, instant exchange is much more easier to indicate because just one function called that I want to take from this token to this token with this amount. So the instant exchange is quite popular in terms of integration with Author protocol as well. And the last thing that order book quite popular because it can gain more profit on the space. It is like on the order book. Order book, the one that gain the profit is from the one that who make that protocol, like the IDEX for example. But for the notebook, they can give us opportunity to provide fund on the pool and get the profit as well. And the benefit is it's easy and fast. User no need to understand, no need to like see the dashboard in many number on the screen that show the bid and ask order book. The screen just show the how much for the price for now, and you just take it. And low cost for the last volume. Because for the diffraction order book, you just pay for the gas fee, right? So it means if you do trade on a large volume, sometimes decentralized chain is much more cheaper than the centralized chain. For the trade-off, if the price is a lot of arbitrage opportunity here, because the price itself is calculated by smart contract. So it means that if ETH price go up, it's appetite opportunity that anyone can take that profit as well. And some decentralized chain have centralized party involved anyway in the pool. For example, like the Kyber and Bencorp. When you want to list your token, you need to pass like the form of that project before you can get list on that exchange. But for Uniswap, it's quite decentralized. Anyone can list any token you have. Like if you write a sell token today, you can go to Uniswap and provide liquidity to the pool and start exchange in the Uniswap pool. And smart contract is much more complex when compared to decentralized, when compared to the order book model. So to show how it works, that for you as a user, you can see that all these exchange is all the same. You just want to buy or sell the crypto. Let's say that this day you see that 0x is the better price. You go to the 0x protocol and you can buy or sell the 0x protocol. But maybe sometime later, a month ago, you want to buy a token again. So you go to Uniswap. Why you go to Uniswap? Because maybe on that day, you search on all the websites, 0x, AirSwap, IDEX, Kyber, Bencoin, so okay, Uniswap is the better price. And you buy or sell with the Uniswap. That's how the today works, right? So it means when you buy on the exchange, you need to search for the market. And let's say if you want to buy like 100,000 worth of cryptocurrency in one transaction, it's really hard because all the DEX right now cannot smart tender for this amount because the liquidity pool is not big enough, the price is worse. So user need to speak to the 5 transactions, for example, to 12,000 each for each transaction to make a better price than instant of trade in one exchange. So can we make it better? Yes, that's how Kulap comes. And actually you might heard that we have the DEX aggregator. The DEX aggregator out there is work like that as Kulap do. Kulap is like the one in the middle that connect all the decentralized chain with different protocol together. Like the one that do the order book, the one that do with the no order book, this pool. And when user ask for us that how much for the 100,000 for the to buy or sell crypto, the Kulap can ask all the transaction and we can like the split trade to different debt to make it better price instead of trade in one exchange. So how it works? We lie in the center and we connect with each decentralized exchange and we have the bot that always scan for the price or each decentralized exchange in real time. This, for example, if I want to trade like the 1 ETH to OMG, the Kulap protocol or the DEX aggregator protocol can give user that, okay, this price right now is trade with the DEX A. But if user trade with 10 ETH, for example, that we now know that, okay, if we give the 10 ETH to one decentralized exchange, the price is not okay. So we can split the trade into transactions, into DEX, but the user just trade in one transaction. And this is the very favorite of me one that we have the multi-root protocol. That sometimes user want to trade for token A and B, and I know that if we allow the user to token C first, for example this one, if we allow user to MKR first and get them high and buy and sell on the auto exchange, maybe the price is better than trade directly for one token to one token. And the last one is the high volume trading. This is the need right now because for the Kulap itself, we have a license, and in the future we might partnership with some company in Thailand that maybe want to take in a large volume, like the financial institution. So we come here for that as well. That if we want to take in a high volume, we can split the trade among this exchange, maybe 10 this exchange in one transaction, and the user no need to touch us because user can do it in one transaction. So it means if the price is less than that they want, our smart contract can cancel for them because we have the like the minimum return parameter that all the client can put to the all smart contract call. So that is the Kulap, and we have exchange that available on the desktop and on the mobile as well. So to summarize that I talking today that we have the order book model that it come first, and later we have the reserve pool model. And almost a year now we have a lot of aggregator that you can search for, like the one in exchange, and deck.ag that they are aggregator as well, and Kulap is one of them that aggregate the protocol as well. And actually the Kulap is start beginning before the one in and deck.ag launch, but yeah, we need to wait for the license. So we quite late now, but I think I can operate this year. Yeah. Yeah.
Congratulations. Thank you very much, good thoughts. Ah,
Do we have time for questions?
sure, of course,
Yeah.
Clayton, go ahead.
I'm just, so I use one instance XAG a lot. I'm just curious if they also support the multi-coin thing that you showed.
Yeah, actually I'm not sure on the slide, but we have that capacity as well. But we will launch later that actually we have two things that we can do with the DEX, but until today no one do yet. That one is a multi-coin trading in one transaction. Actually it's quite neat for like if you have the coin that not much value like the 10 coin, you can swap in one transaction to the DAI, for example. Another thing we can do like the group trading in one transaction, because as I search throughout the market, actually if you trade in the swap with the big lot, you will got the better price than you split it, that is split out to different transactions. So it means if we group the user like 100 users to trade on the one transaction, the price will be better. That we can do as well. Yes.
One question about the license. You mentioned you're getting an SEC license or on exchange, right?
Yes.
And what is the reason for this?
Because we are Thai. Yeah, that's it. Actually, that is the answer as well. And other thing is, if we go like to Singapore or other country, I ask myself that actually I research on the industry myself that it's like we look back to the centralized exchange. Actually, even in Thailand, central exchange it come before the law. So it's and this year we see that Binance or central exchange comply with the law now. So I see also in the future that if we run out the law, eventually we need to put a license anyway in one day. So why not just we are Thai and we have the first country in the world, like for example, like 5 countries in the world, that first 5 countries in the world that have the law for the joint state. So why not we just ask for the license?
It's a good timing indeed.
Yeah, but it got challenged a lot. It cost a lot actually.
Okay, one more question.
So I just wonder in what sense it's decentralized, then maybe non-custodial, but in what sense is it decentralized?
What the sense that build a decentralized?
In what way is it decentralized if I need to give you my KYC, you need to report to the government?
Yeah.
So in what sense is it actually decentralized?
Yeah, I think that's one is a very good question. Because I got that question a lot. Because this election, this day, you need to for the KYC, but actually you need, if you take like let's say the 10,000 volume each day, you need to make the KYC on the Kyber as well. So the company right now actually gonna apply for the law for now. But for me, if you ask that you don't want KYC, yeah, the Kulap is not suited for you. But you can see that if you want to hold your fund in your wallet, you want to be the one that control your fund, and you want to exchange in a safe way, maybe Kulap can your answer, because we got the law, we got the protection. You can suit me as well if we load your fund in the smart contract, for example. So maybe you may quite compatible trading with us if you are serious about that thing. But if you think that you can take care of yourself, maybe you can go to Uniswap that don't need the KYC. I'm not sure that answers your question.
One more.
Is it safe to assume it's like a KYC middleware layer to find the best match on the vectors? So you don't actually advertise that as a dex, dex aggregator.
Actually, in Thailand, We don't got the license that's called a decentralized exchange. We got a license that's called a decentralized broker. We call the EDC in Thailand, describe us as a broker because we are on the center that connect with all 30 exchange. So we have a decentralized broker license. So we just ask you for the KYC only once, and we can give you to trade different exchange that don't have the KYC now all over the world. So it means if you are the company that you need to comply with the law, yeah, you can choose an instance of trade directly to the Kyber. Because the Kyber don't have the KYC, the law protection, but we have, and we connect with the Kyber anyway.
Okay, thank you very much, Khun. I will just 1 minute before the pizzas are getting cold. There is some beers and pizzas waiting for you. But just before we leave, I just wanted to give you just a small slide about Defi score. I don't know if you heard about it, but this is from Consensus. This is actually giving a score to the decentralized finance platforms. And it's actually very interesting to see how they are actually giving the score, what do they audit, what part of the contract they look at, and you have some rates from each decentralized platforms. And I don't know if you want to use that, you want to use decentralized finance and you want to know which platform is maybe the best or the most secure, this is actually a very interesting product to look at. It's free. It's actually welcoming for developers, so you can connect by yourself, you can make recommendations. This is totally open source, and this is actually a very great tools to get more information on those different platforms and protocols. So just if you want to go on it, it's Defi score, and it's very interesting. And last thing before we close it, thank you very much all for coming tonight. I know there were a lot of DeFi meetup this week, and thank you very much for coming. Last thing, we are at Nattapon, we are recruiting developers and marketings. We are growing our companies. If you are interested, please come to talk to us. Thank you to Clayton, thank you to Khun, thank you very much for all of you. The pizza are there. The food now.